Hey everyone. Today we're diving into an important concept that plays a major role in how real estate transactions happen behind the scenes, and that is the secondary mortgage market. So whether you're just starting out in real estate or looking to deepen your understanding of how the mortgage market works, today's video is going to help you get there. Now, we don't get cold days in Florida often, and it's a little chilly outside. Whenever that happens, it makes me want to get a fire going and tell some stories, so that's exactly what I'm going to do. Today, I'm going to start the video with a story that I hope brings the secondary mortgage market to life. Here we go. Meet the Smith family. Their Paul has been hired in a new town as a belt maker. Well, because apparently he loves belts. They moved to Lonely Plains, a tiny little town where they connected with Randy, the rootinest, tootinest realtor in the entire Wild Wild West. He guarantees he'll get you the best deal or else. Together, they found their dream home. Then the Smiths moseyed on over to their local bank to get a mortgage in exchange for a big bag of cash for the sellers. Everything sounds great so far, right? Well, the Smiths aren't the only family in town looking for a mortgage. In fact, there are folks lined up at every bank in Lonely Plains because the rumor is that there's gold in them there hills. And that's a problem because the local banks only have so much money in their vaults to lend. And if the bank has no money to lend, well, they just have to shut their doors and become a ghost town in the middle of this boom town. But luckily, there's a magical place called the secondary mortgage market where local banks can exchange their valuable IOUs for cash, which will restock their vaults and allow them to continue to provide mortgages for the good people of Lonely Plains. Now, don't you worry about that secondary mortgage market. They're going to take all those loans from all those local banks and package them up and sell them in shares as mortgage-backed securities to investors. This way, they can fill their coffers again and keep the money flowing. And folks, this is how realtors, bankers, people all over America, even in small towns like Lonely Plains, work together to keep achieving the American dream. Now, I know we're talking finance, but there's sure to be some history nerds out there that will point out the fact that my story is not historically correct. And sadly, this is true. The secondary mortgage market was created in the 1930s in the Wild Wild West, and Randy, the rootinest, tootinest realtor, would have been long gone by then. But the main point still rings true. The secondary mortgage market is the magical place that keeps the real estate market alive. In fact, Fannie Mae and Freddie Mac are two government-sponsored enterprises, often just called GSEs, that were created to purchase loans from banks, bundle them together into mortgage-backed securities, and then sell them to institutional investors on Wall Street, like pension funds or insurance companies and other investors worldwide. In fact, they purchase nearly 70% of all the loans on the secondary market and essentially provide a guaranteed buyer for banks' mortgage loans, which keeps the money flowing. There are situations where a local bank will not sell a loan. These are called portfolio loans. And this is generally when the loan does not meet Fannie Mae or Freddie's guidelines, but we'll talk about that a little later. I do want to mention that just like anything else, there are both pros and cons to the secondary mortgage market. Some pros are there's increased liquidity. So banks get their cash back quickly, and they can then lend that money back out to another customer. There's also an increase to access to financing. So more buyers can qualify for loans because lenders aren't as constrained. They don't have to tighten their qualifications or try to maximize profits on loans when their funds are running low. This also creates stability in the market, but there are some cons as well. Not that many, but one is risk layering. Loans can be bundled and sold multiple times, making it hard to track the true risk. This is something we saw lead up to the 2008 financial crisis. Another con would be the lack of personalization. When banks know they're selling a loan, they may rely more heavily on automated underwriting and less on personal relationships. There are situations where a small local bank will take on a new customer, maybe doing a lot of development or making some big moves in the area, but may not have the documentation for a traditional loan. But in order to keep them as a customer, the bank will keep the loan in-house as a portfolio loan. When this happens, I think the bank is a little more involved with that customer, and a relationship builds. Still, even with a few imperfections, the secondary market is vital. Without it, local banks would not be able to help nearly as many home buyers, as some markets would possibly shut down altogether. An interesting side effect of the secondary market is that it has gone a long way into standardizing the loan process. Thanks to the secondary mortgage market, banks now follow very similar documentation on underwriting standards and on borrowers' requirements. Why? Because loans that don't meet GSE guidelines aren't eligible for sale to the largest buyer out there. Remember, there's a 70% chance Fannie or Freddie will be buying the bank's loan, so it would behoove them to create a loan just the way Fannie and Freddie like them. Even if it is bought by another investor, that investor would also want the loan to be appealing to the largest buyer on the market, just in case he decides to sell it. So if you're a buyer, it doesn't matter whether you're borrowing from a small bank in Lonely Plains or a national lender, the loan process will feel familiar and follow similar benchmarks. That consistency is a byproduct of the secondary market's influence. Now let's bring this full circle. Local banks benefit the most from this system. In Florida, for example, there are banks who know the local landscape better than any national chain ever could. They understand flood zones, HOAs, seasonal fluctuations, but what they don't have is unlimited cap. Thanks to the secondary market, these local banks can continue to serve more local families while Fannie and Freddie take care of turning those loans into national investments, so that real estate engine can keep chugging along. I hope you found this video insightful. If so, give it a thumbs up and subscribe for more real estate insights. Until next time, thanks for watching, and I hope to see you again soon.